Strategies video, we're going to talk about the bear put spread. Now, the bear put spread is constructed by purchasing a put option while also selling another put option at a lower strike price. So, a bear put spread is similar to buying a put, but the strategy has less risk and also limited profit potential. So, let's go ahead and get right into the strategy characteristics. So the purchase of a put spread is also referred to as a long put spread, a put debit spread, or a bear put spread. Now this is a bearish option strategy that consists of purchasing a put while also selling another put option at a lower strike price. Now compared to buying a put outright, the bear put spread has less profit potential and less risk. So it's a more conservative strategy that is not as aggressive as a bearish play as just buying a put option by itself. So the maximum profit potential of a bear put spread is the width of the put strikes minus the debit paid times 100. Now the maximum loss potential is the net debit paid. Now if you'll recall, if you buy a put option, the most you can lose is the premium that you pay for the put. Now with a put spread, since we're selling another put against the long put, we're going to have a debit that's smaller than just buying the put outright, and therefore we'll have a lower loss potential. Now the expiration break-even price is going to be the long put's strike price less the debit paid. Now the probability of profit for a bear put spread depends on if the spread is in the money, at the money, or out of the money. So if you buy a put spread that's entirely in the money, you don't need the stock price to move to profit. In fact, the stock price can actually increase and you'll still make money. Now keep in mind though that you're going to pay more of a premium for an in-the-money put spread, and therefore you're going to have more loss potential and less profit potential. Now if you buy a put spread where the long put is in the money and the short put is out of the money, that's going to be called a at-the-money put spread, and the approximate probability of profit for that position is going to be around 50%. Now if you buy a put spread that's out of the money, so if you buy an out-of-the-money put and sell an even further out-of-the-money put, the probability of profit is going to be less than 50%. Now that's because you're going to need the stock price to decrease significantly just to break even or make any money on the trade. Now the resulting position after expiration depends on if the spread is entirely in the money or only partially in the money. If both puts are in the money, the exercise and assignment will offset and no stock position will be taken. So the long put will expire to negative 100 shares of stock, and the short put will expire to plus 100 shares of stock, and those will offset each other, and the spread will just settle to its final value at expiration. Now if only the long put is in the money, the position will expire to negative 100 shares of stock per long put contract. So if you have a bear put spread and only the long put is in the money at expiration, if you don't want a stock position, you're going to have to close that long put. Otherwise, that long put's going to automatically exercise and turn into negative 100 shares of stock per long put contract. Now, in regards to assignment risk, the short put is going to be the one that you can be assigned on. So if the put spread is deep in the money, you're at risk of being assigned on that short put, and this assignment of that short put will result in a stock position of plus 100 shares per short put contract. So now that you know the general strategy characteristics for the bear put spread, let's go ahead and look at a hypothetical example and take a look at the expiration risk profile graph. So here we have a bunch of strike prices and the corresponding put prices, and let's say that when these option prices were quoted, let's say the stock price was trading for $135. Now, let's say we have a bearish outlook on this stock and we buy the 130-120 put spread. So we're going to buy the 130 put for $5 and we're going to sell the 120 put for $2. Now, since we're paying $5 and receiving $2, our net debit on this spread is going to be $3. Now, since the difference between the strikes is $10, the most this spread can be worth at expiration is $10. And since we paid $3 for it, the most we can profit is $7, and the most we can lose is $3. So let's go ahead and take a look at the expiration risk profile graph for this position. Alright, so as previously discussed, the most we can lose on this spread is $3, or in dollar terms, $300, and the most we can make on the spread is $700. Now that's because we paid $3 in premium for a $10 wide put spread, and if the put spread is worth $10 at expiration, we're going to make a profit of $7 or $700. So as we can see here, we have more profit potential than loss potential, and that's going to lead to a lower than 50% probability of profit. Now that should make sense because the stock price at entry is $135, but we need the stock to drop to $127 just to break even, and we need it below $127 if we want to make any money. So since we need the stock price to fall more than $8 to make any money, this spread has a lower probability of profit and therefore has more profit potential than loss potential. So if the stock price is anywhere above 130 at expiration, both the long put and the short put will expire out of the money and expire completely worthless. Now, since we paid a net debit of $3 for this spread, we're going to lose $300. Now, if the stock price is right at 127 at expiration, that long 130 put is going to be worth $3, while the 120 put will expire worthless. Now, since we paid a $3 premium for this spread, and the final value of the spread at expiration is $3, if the stock price is at 127, we're going to break even. Now, if the stock price is at 120 or below, this put spread will have a value of $10 at expiration, and since we paid $3 for it, our profit will be $700. So now that you've seen the expiration risk profile graph for a bear put spread, let's go ahead and take a look at a few real examples to show you how the bear put spread performs as the stock price is changing over time. So the first example we're going to look at is where a trader buys an out-of-the-money bear put spread. So here's the setup. The initial stock price is $207.78, and to construct this bear put spread, we're going to buy the 205 put for $2.10, and we're going to sell the 200 put for $1.13. Now both options are expiring in 35 days. So since we're paying $2.10 for the 205 put and we're collecting $1.13 for the 200 put, our net debit paid in this example is 97 cents. Now that brings our break-even price to the long put strike price of 205 less than 97-cent debit, which comes out to 204.03. So we need the stock price below 204.03 to break even or make money on this trade. Now the maximum profit potential is going to be the $5 wide strikes minus the 97-cent debit times 100, which comes out to $403. So since we paid 97 cents for a $5 wide spread, the most we can make is $403 at expiration. Now the maximum loss potential is going to be the 97-cent debit paid times 100, which comes out to $97. So right off the bat here, we can see that the most we can lose is $97, but the most we can make is $403. Now since we have significantly more profit potential than loss potential, you should know that this spread has a lower than 50% probability of profit. So anytime you have a put debit spread, or any debit spread for that matter, where your profit potential is significantly more than your loss potential, you have a low probability position. So let's go ahead and see how this position performed through time as the stock price changed. Alright, so as we can see here, the stock price started right around 207.50, and the long put strike is 205, while the short put strike is 200, and our break-even price is 204.03. So over the first 15 or 16 days or so, we can see that the stock price falls from 207.50 down to 205. Now during that time frame, the price of the put spread actually fell from 97 cents to around 60 or 70 cents, and with around 15 days to expiration, the put spread was actually worth $1.50. Now that's because the stock price was falling and actually touched our long put strike of 205 at one point. However, at expiration, the stock price was above the long put strike price of 205, and in that case, the entire spread expired worthless. So since we paid 97 cents for this spread and it expired worthless, our loss would be $97 per put spread. So this just is an example that shows if you buy an out-of-the-money put spread, you really need the stock price to decrease quickly and be below your put spread's break-even price at expiration. Otherwise, you're not going to make any money. So one of the dangers of buying an out-of-the-money put spread is that you need a big stock price movement in a short period of time, and there's generally a low probability of that happening. Alright, so in this next example, we're going to look at a at the money bear put spread. So that means we're going to buy a in the money long put and we're going to sell a out of the money put. So here is the setup. So the initial stock price is 104.08 and we're going to buy the 115 put for 15.85 and we're going to sell the 100 put for $7.35. Now again, both options are expiring in 35 days. So the net debit paid in this example is 15.85 minus 7.35, which comes out to $8.50. That brings our break-even price to the long puts strike price of 115 minus the $8.50 debit, which comes out to 106.50. So our maximum profit potential in this case is the $15 wide strikes minus the $8.50 debit times 100, which comes out to $650. Now the maximum loss potential is the debit paid of $8.50 times 100, which comes out to $850. So in this case, we can see that the profit potential is actually less than our loss potential, which means that this spread has a higher than 50% probability of profit because we have more loss potential than profit potential. And also, if you look at the break-even price, the stock price is actually at 104.08 while our break-even price is 106.50. So the stock price can rise about $2.50 and we can still not lose money on this trade. So all of those factors combined tells you that this spread has a higher than 50% probability of profit. So let's go ahead and see what happens as the stock price is changing through time. So in this example, we can see that the stock price starts right around $104. Now our long put strike price in this case is $115. Our short put strike price is $100, and our put spread break-even price is $106.50. So as we can see here, as the stock price is decreasing over time, the put spread is increasing in value over time. Now that's because as the stock price continues to fall and is, well below the short put strike price, this bear put spread has a higher and higher probability of expiring in the money, and therefore the put spread's price is more valuable. So since the strikes are $15 wide, the most this spread can be worth is $15 at expiration. Now we can see that around 11 days to expiration, the spread is actually worth its maximum value of $15, or at least very close to $15. And at that point, it would make sense to sell the spread because with 11 days to expiration, we've realized essentially the maximum profit potential. But if the stock price reverts and somehow ends up above $115 at expiration, that $15 spread value that we are holding on to now could be worth nothing. So if you have a long put spread and it's trading near its maximum profit before expiration, it's always a good idea to go ahead and sell that spread because you basically have nothing left to gain but everything left to lose. So this is just a simple example that shows when you own a put spread and the stock price moves favorably in a short period of time, it's very possible to reach the maximum profit potential of the trade well before expiration, in which case it's always wise to close the spread. Alright, so in this last example, we're going to look at a situation where a trader buys an in-the-money bear put spread. Now that means the long put and short put will both be in the money at the time of trade entry. So here's the setup. The initial stock price is $127.88, and we're going to buy the 132 put for $4.93, and we're going to sell the 128 put for $2.13. Both options expire in 31 days. Now our net debit in this case is $2.80 because we paid $4.93 for the 132 put and received $2.13 for the 128 put. Now that brings our break-even price to the long put strike price of $132 less the $2.80 debit, which comes out to $129.20. Now in this case the spread is $4 wide, and since we paid $2.80 for it, our maximum profit potential is $120. So that's the $4 strike width minus $2.80 times 100, which comes out to $120. Now our maximum loss potential is the $2.80 debit paid times 100, which comes out to $280. So let's go ahead and take a look at what happens to this spread as the stock price is changing over time. Alright, so as we can see here, the stock price starts right around $128, and we purchased the 132, 128 put spread for a debit of $2.80. Now, unfortunately, in this example, the stock price increased steadily and at expiration was just below the long put strike price of 132. Now, this means that the put spread did not expire entirely worthless at expiration, but it was essentially worthless because the long put was only worth a couple cents. So, since we paid $2.80 for the spread and it was essentially worthless at expiration, the loss per spread would be around $280. So this just goes to show that even when you buy an in-the-money bear put spread, even though you have a high probability of profit, there's always the potential for the stock price to increase, in which case you're going to lose money when you own a put spread. Alright, so let's go ahead and recap the summary of main concepts from this video. So first of all, buying a put spread is a strategy used by traders who have a bearish outlook for a stock. Now the strategy is less risky than buying a put outright, but also has less profit potential. So you're giving up some of the profit potential by reducing your cost and selling that put against the long put. So buying a put spread can have a low or high probability of profit. If the profit potential is significantly more than the loss potential, the spread has a low probability of profit. Now, if the profit potential is significantly less than the loss potential, the spread has a high probability of profit. So the ratio between your potential gains and potential losses will always give you an indication of that spread's estimated probability of profit. Now lastly, if the long put is in the money at expiration, a trader will end up with negative 100 shares of stock per long put contract. So that's a short stock position of 100 shares per long put. Now if the entire spread is in the money at expiration, the exercise and assignment of the shares offset each other and no stock position is taken.